Hi everybody, welcome back to Chapter 8. Double declining balance method of calculating depreciation is discussed in your textbook on pages 308 and 309. But let's go over the rules and let's go over an example in this quick video. Rule number 1, A here. Do not use salvage value in your calculation until the last year. Rule number 2, B here. The rate of depreciation is twice or double the straight line rate. Rule C, multiply the doubled rate of depreciation times the book value of the asset at the beginning of the accounting period. Let's work through an example and apply these rules. On March 8th, 20X1, we purchased a truck for $53,000 with an expected useful life of 5 years. The truck is expected to be sold at the end of 5 years for $5,000. Let's calculate the straight line percentage of depreciation for this asset. Well, over 5 years, we want to take 100% of all the depreciation allowed. So 100% is to be taken if 100% is to be taken over 5 years, then all you need to do is take 100%, divide that by 5, and that equals 20% per year. So if we were to calculate straight line depreciation, we would be taking 20% of all the depreciation that's allowed on the asset each year. Now let's calculate double the straight line rate. Well, double the straight line rate would be 20% times 2 equals 40%. So under double declining balance of depreciation, the rate of depreciation on a 5-year asset is going to be 40%. Let's calculate the depreciable basis of the truck. As always, the depreciable basis is the cost minus salvage value, and that will equal $53,000 in this example, minus the $5,000 salvage value, and that equals $48,000. But don't forget rule number 1 up here. Do not use salvage value in your calculation until the last year. I'm only having you do this now so that you won't make a mistake when you get to the last year. So follow me through, have a little patience, and I'll show you where we're going with this. Therefore, what is the maximum amount of depreciation that will be taken over the life of this truck? $48,000. So let's complete the depreciation schedule for this asset using double depreciation balance. Remember rule number 1, do not use salvage value in your calculation until the last year. So what was the book value of this asset at the beginning of X1? Well, remember that book value is defined as cost minus accumulated depreciation. In year 1, we didn't have any accumulated depreciation at the beginning of X1 because it's a brand new asset that year. So $53,000 of cost minus 0 accumulated means our beginning balance is $53,000. What's our rate of depreciation? double the straight line rate? Well, we calculated that up here at 40%. Now, for depreciation expense for year one, you have to be careful. Notice I've got a note here. If you go down and read the note that I gave you, it says, if this asset had been put into service on January 1st, X1, we would claim a full year or a full 12 months worth of depreciation expense in X1. And that would be calculated by taking the $53,000 of cost times 40% to equal $21,200 of depreciation expense. But we have not used that asset a full 12 months in this year, so we have to claim only 10 months worth of depreciation expense, $21,200, a full 12 months of expense times 10/12 equals $17,667. And we are going to be rounding our numbers to the nearest dollar. So 17,667 is our year one depreciation expense. Now, you probably know from working with prior depreciation methods that accumulated depreciation is beginning balance plus current year expense. There was no beginning balance in X1, so our depreciation, accumulated depreciation at the end of X1 is 17,667. And the book value, as you know, is cost minus accumulated. So cost of $53,000 minus the accumulated. So our book value at the end of X1 is $35,333. Notice rule number 3, or C here. Multiply the doubled rate, which is 40%, times the book value at the beginning of the period. So this is what we mean by double. The 40% is doubled rate, and declining balance is the declining book value. So we bring this book value at the end of X1, it's the beginning book value in X2, and we bring that over here. The rate does not change. And the calculation method does not change. Simply multiply the doubled rate times its declining balance. So depreciation expense for year 2 is $14,133. The balance of accumulated depreciation then is the beginning accumulated depreciation plus current year expense, and the book value then is the cost minus accumulated depreciation, and this is the declining balance. This book value at the end of X2 is the book value at the beginning of X3. So I want you to go ahead and finish this schedule. Pause the video. Let me get it down to the bottom so you can read note 2 as you're doing your work. Finish the schedule, pause the video, finish the schedule, pay particular attention to note 2 in your last year of depreciation expense. And once you finish the schedule, start the video again and check your work. So year 3's depreciation expense is the beginning book value coming from here times 40% or $84.80 accumulated depreciation grows, book value declines, year X4, year X5, then we have to be careful. We have to be careful about X5's depreciation expense. As explained in this note, we already claimed $45,368 of depreciation expense by the end of X4. The total amount that we can claim, that's why we did these calculations up here, is $48,000. We cannot exceed $48,000 in depreciation expense. Therefore, in X5, the maximum amount of depreciation we could claim is $2,632. Maximum of $48,000 minus the amount claimed through X4. If actual depreciation expense in X5 is less than this amount, then use the actual and go on to finish the depreciation in X6. If the actual depreciation for 2005 is greater than this 2632, then claim only the 2632. And that's why we have 2,632 here. And that maximizes the amount of depreciation expense claimed throughout its life to $48,000. And it limits the amount of accumulated depreciation at the end of its life to $48,000. And it limits the book value to $5,000. Remember, you can never depreciate salvage value. Well, that's all for this video. When we come back, we'll talk about some other aspects of accounting for plant assets.